Thank you very much, Peter. And thank you. Go ahead.
Look at his stern face. It looks like he's about to deliver very bad news.
Including at the Fed.
He has some not fun news to deliver, it looks like.
Can you discuss topic over the last year and a half? Those conclusions may have.
So, Peter, thank you, and Jim, thank you, and congratulations to both of you and to Cato on 40 years of great monetary policy conferences. So I think a good entry point for that question, Peter, is to start by recalling that before the pandemic, unemployment was at a 50-year low, inflation was low and stable, and the economy was growing steadily, with no obvious imbalances threatening continued expansion. So, of course, in that sense, none of this high inflation that we see around the world now would have happened without the pandemic. The pandemic severely disrupted the economy, gave rise to risks of much more dire economic consequences than actually transpired really, and that was thanks in part to the policy response. So to start with policy, there's no question that policy certainly supported strong demand, but in my view, you would not have seen anything like the inflation that we have seen without the pandemic effects. And those pandemic effects include both shifts in demand and also playing a role in, not solely causing, but playing a role in the supply side constraints that emerged. So as for the pandemic, it did lead directly to an extraordinary shift in demand away from in-person services and to goods. And that shift, of course, was a major contributor to inflation in goods prices, which was really the main inflation story at the very beginning when inflation broke out suddenly in March of 2021. It's worth remembering that inflation actually declined in the early stages of the pandemic and then suddenly rose up in March of 21. The pandemic also contributed to constrained supply in a number of important ways, including a large and persistent reduction in the size of the labor force, which contributed to extremely tight labor market conditions and upward pressure on wages. Also, the turmoil in global supply chains was probably caused to some extent by pandemic-related shutdowns as well as strong demand, and particularly goods demand. I think cars are a good example. So yes, people had money and rates were low and demand for cars was strong, but also the pandemic shifted demand upward for cars because some people wanted to avoid public transportation. That amped up new demand for new and used cars. And also the shortage of semiconductors for cars emerged from pandemic-related demand shifts as well. So, the bottom line for me is that there's really a role for both here, and the two are tangled up in a way that it's really not easy to disentangle.
The 70s, I worry whether we have the result.
Sure. So I think it's
That's interesting how he tries to break the ice and get a smile out of Powell, and it just won't happen.
What Paul Volcker did and the Fed did to finally get inflation.
I mean, you can just tell that Powell's looking to get very serious on these rate hikes.
Over the course of that long period of great inflation is that the public had really come to think of
75 basis points on the table for sure,
and to expect it to continue. And that's what made it so hard to get inflation down in that case. So it is very much our view and my view that we need to act now forthrightly, strongly, as we have been doing, and we need to keep at it until the job is done to avoid that. We think we can avoid the kind of very high social costs that Paul Volcker and the Fed had to bring into play in order to get inflation back down and set us up then for a long period of price stability. That speech, the point really there was to deliver a speech that was narrowly focused on inflation, more direct and a lot shorter than a typical Jackson Hole speech. And I thought that what was appropriate was a very, kind of concise and focused message. To your question, the message really was that the Fed has and accepts responsibility for price stability, by which we mean 2% inflation over time. That, again, to your question, the longer inflation remains well above target, the greater the risk that the public does begin to see higher inflation as the norm. And that has the capacity to really raise the costs of getting inflation down. So finally, history cautions strongly against prematurely loosening policy. I can assure you that my colleagues and I are strongly committed to this project, and we will keep at it until the job is done. I can also assure you that we never take into consideration external political considerations. We are accountable to the public through Congress. That's a very fundamental, important aspect of our work. But we do not. We focus solely on the goals that Congress has given us, and that's what we're going to do here.
I think that it's clear that we could see mentioned in his and just reiterating the point about at a time when inflation
the framework, we began the work on the new framework and announced the results in August of 2020, and it really followed 25 years basically of global disinflationary forces, and the problem was that monetary policy rates were close to the effective lower bound much too much of the time, much too close, and even during good times. So that meant that central banks were having a hard time all over the world, finding ways to support the economy when it was needed, and that's why central banks, including the Fed, resorted to things like forward asset purchases. So that's why we did that. But the changes that we made were sort of a very mainstream part of a literature around makeup strategies. But really, the point of our framework changes, the point of all of them, was to, and we said this very clearly, was to have inflation expectations well anchored at 2%. That the average inflation targeting idea was meant to support having inflation expectation. That is the goal at 2%. And the reason is that we believe that the public's expectations of future inflation will play an important role in the actual path of inflation. So that is kind of the fundamental basis of our framework. And as I just discussed, it is very important that inflation expectations remain anchored. I think the evidence today is that if you look at longer term expectations by households, businesses, and forecasters, and also markets, you'll see that they are pretty well anchored around 2%. Of course, short term expectations are higher because of high current inflation, and also the clock is ticking. As I mentioned, the longer that inflation remains well above target, the greater the concern that the public will start to just naturally incorporate higher inflation into its economic decision making. And our job is to make sure that doesn't happen. And we're committed to doing that job.
that the labor shortages.
Well, I think you're right that if it does turn out that we are in a persistent labor shortage over time, that'll be a challenging world for companies, and it will certainly create upward pressure on wages and that sort of thing. Today, the labor market demand is very, very strong still in the labor market. We're still printing new payroll job numbers at a high level. Wages are at elevated levels, and so we think by our policy interventions, what we hope to achieve is a period of growth below trend, which will cause the labor market to get back into better balance, and that will bring wages back down to levels that are more consistent with percent inflation over time. That's what we're trying to achieve. The shock to labor supply that we got from the pandemic was large and expected, and unfortunately persistent. I will say that just in the very last labor market report that we got last Friday, we did see a welcome increase in labor force participation. Nonetheless, still a full percentage point below crisis, and I think it's important as a society that we have measures in place to support a strong labor market and high labor force participation, and that goes beyond what we can accomplish with monetary policy.
Some other distinctions are days before the internet. Fidelity office to see the money travel. I'm just wondering, how do you respond when people look? I think you answered this in part.
So I graduated from college in 1975, which was close to peak monetarism, and there was quite a focus on monetary aggregates. So to go to this current situation, so as part of our response to the pandemic, we did resort to large asset purchases to address what were pretty severe disruptions in markets, and then also to support the economy, and our balance sheet expanded dramatically. But remember that our securities don't actually the quantity of government obligations held by the public. They really change the mix because we issue bank reserves to pay for those securities. So we're not changing, the quantity of obligations. That is not to say that money growth wasn't high. It was, of course, extraordinarily high in 2020, and then slowed down in 21, and now is quite sluggish. And I guess I would just say it this way: whatever caused, there are different theories on what caused the inflation that so suddenly jumped up out of the ground in March of 2021. Whatever that cause was, the relationship between the money supply and inflation, economic output, has been much more unstable than it was in Friedman's day for a very long time. And so literally changes in monetary aggregates have not had a consistent, reliable relationship. They haven't been a good predictor of the economy or of inflation. Now, of course, the economy is ever changing, and that too could change, to where it is important again. But for now, and for really many years now, monetary aggregates don't play an important role in our formulation of policy, and we don't think they're generally a good way to think about policy or about inflation. It's more about demand and supply and things like that. So that's where we would be on that.
We do have a strong aversion. Like to socialize, promote alternative framework, policy. take some of this discretion, Jim. Potential monitoring, and that kind of calls into question.
Seven minutes until market open. We're watching PIXY.
So more broadly,
and of course the market.
Rules, of course, Taylor rules have become part of the fabric of economic analysis, and particularly monetary policy analysis, in ways that must be far greater than John Taylor could have hoped when he wrote his 1993. So, but no central bank and the Fed has never explicitly tied our monetary policy decisions to any formula, including Taylor rules. But Taylor rules, nonetheless, are ubiquitous in all of the work that we do. You have to have a variable, a way and a model of explaining how monetary policy will react, and some kind of Taylor rule is now very much part of the way. In terms of nominal income targeting, and by the way, I know that KO is one of the home courts for nominal income targeting, along with Mercatus and some others. And I know that this is a lot of well-known experts, many of them at your institution, do support nominal income targeting. And I'll just say that we've looked at that. I've looked at that and really come to the view that nominal income targeting is not the right way to go. And I'll try to explain why. By the way, I know that these arguments are well known to nominal income targeters and found to be unpersuasive. But nonetheless, I'll just give you my.
And one thing I would interject is that we have debates. I think for us, the concept and remove.
I think it's a very healthy process, and the whole debate over many years about rules and discretion is a fascinating and important one that is far from over. So it's really a mix of the two. I think but getting to nominal income targeting, we've got a dual mandate: maximum employment and price stability, and it comes down to is nominal income targeting the best way to promote that? We don't think it is. I don't really think it is, and part of that just is that it would be, I think, very difficult to explain to the public the relationship of a nominal income target, nominal GDP target to those goals. It's just it's a level of complexity that even some economists and policymakers struggle with, let alone the general public. So it seems like it would be a reach to sort of put the for us to have that be our fundamental framework. And a couple of examples that would be difficult. One in particular would be, what do you do with changes in trend growth? Have highly uncertain estimates of levels of trend growth that we amend down through the year.
This could be a good time to get into PIXY, PIXY. It's getting close to VWAP.
Broadly understood, I think, or believed.
Pulling back, you would put your stop below the prior pivot low, roughly $22.
How do you incorporate that into
if it breaks $22, it's not good. And yet we're at $23.91 with a high breakout potential, 26, like $27. So you've got $2 to the downside,
because we just don't know these things with that,
and
we don't know any of
$4, $3 to the upside, and potentially more.
It's
once the
really,
market
really
opens.
Interesting, and it works very well in models, but it seems difficult to implement from a practical standpoint, and it's not something that we have chosen to do or that we are currently looking at.
I don't want to ignore the unemployment rate during the conversation. We obviously have an aversion. Acknowledges that maximum
Peter, as you know, we were created by Congress in statute, and Congress assigns our goals, and it has assigned maximum employment and price stability. It's my view that the dual mandate has served the public well and is generally workable. In particular, at the moment, I don't see the two goals as in conflict at all, because without price stability, we will not be able to achieve the kind of strong labor market that we want for a sustained period that benefits all. So I don't see a case for moving to
Market just started dropping more
mandate, but that's really a question for Congress, and we will of course implement whatever mandate Congress gives us. To your point about maximum employment, it's true that, and we do say that and have for some time, that non-monetary factors are really what drives the level of maximum employment, which clearly changes through the business cycle and over time. But we can and do assess that, and we do it transparency, and Congress has said that should be a goal, a co-equal goal with price stability. So that's what we're implementing. And again, I don't think there's a strong case for changing that. I don't think it hampers us in our pursuit, and I think we can achieve both goals in the medium term.
Follow up, because you started out saying Congress sets the mandate, and so I answered that, but I guess a natural follow-up might be then that they weren't enough, adding more, like racial equity. Continue expanding the Fed's mandate.
So I think our current mandate is appropriate, and I would not want to see it narrowed or broadened for that matter. We've got narrow and we've got well-defined goals that we're supposed to pursue. And what we've gotten with that is a precious grant of independence that lets us pursue those goals without direct political control.
Market is open.
Monetary policy, that's maximum employment and price stability. And I think that dual mandate has served the public.
Market is dropping.
I really don't think it would not be a good idea to broaden it to goals that might be inconsistent with those two mandates, and it would be very difficult for us to achieve with our tools. More broadly, I think it's really important that we stick to
PIXY starting to come up.
Tasks and resist the temptation to take on issues that are the province of elected Congress. And if we do that, if we do stray from our core mandates, that will eventually undermine the case for our remaining independent. And I think Fed independence is an institutional arrangement that has served the public well, and I think that's pretty well documented and accepted.
About fully discretionary. Biggest of those.
Asana is breaking down. There's gap fill on Asana. Chris is probably all over that.
And doubling it again. Shed some light for us on where you hope to take. Ever moving back to a spiritual.
Sure. So in the last cycle, after we ended our asset purchases, we froze the size of the balance sheet in 2014 and then allowed it to shrink passively relative to the size of the economy for about 3 years. So as the economy grew, the balance sheet didn't grow. Then in 2017, we began to allow maturing assets to run off, and that process went on until 2019. By the end of that period, we had a balance sheet that was significantly smaller relative to the size of the economy and smaller than it was overall. So then we resumed asset purchases, as you know, 2020, and once again now we are embarked on shrinking the balance sheet, and the test will be back to levels that satisfy the public's demand for our liabilities. That's currency and reserves and things like that, but also with reserves maintained consistent with our ample reserves regime. So the balance sheet is substantially larger now, obviously, and consequently the runoff process is designed to be substantially faster than in the last cycle, to the tune of on the order of $1 trillion of runoff. That process began in June, once it's up to full speed. The process began in June, and the pace of the balance sheet increases, actually rises this month. The plans are spelled out in detail on our website around January and May. And of course, one thing we always say is that we're prepared to adjust the details of the plan based on economic and market. As far as returning to a scarce reserve regime, I guess I would say that I think that our current operating framework is a better one, and I don't see a case for returning to scarce reserves. Now, why is that? So the world has really changed as a result of the global financial crisis and the pandemic. The scarce reserves framework would challenge to work in a world where there's very high and sometimes volatile demand for safe and liquid assets. Central banks may need to rely on lower scale asset purchases again from time to time in response to severe shocks. And remember that the large financial institutions hold very, very large quantities of safe assets now as a liquidity buffer, and that includes a lot of reserves. So the bottom line is that the quantity of reserves is just so much higher. It would seem to be impractical to try to manage scarcity, and demand will be volatile too. So it doesn't seem practical. And again, we think that the current system works well and provides a lot of liquidity to the system, which is kind of a net gain.
Here's a little bit away from policy. Horrified at the privacy. Since then, the Fed has formally stepped into the digital currency. Digital currency has obviously been Fed has stepped into this arena. Our team has reviewed the more than 2 central bank digital currency discussion paper received. Find that about 2/3 of them bank system, some of the same serious concerns about privacy and freedom be reconciled.
Let me start by saying that we haven't made any decisions at all about whether to issue a CBDC, and we continue to evaluate the pros and cons and look at the technical questions and the policy questions, and we expect that evaluation process is going to take some time, appropriately so. Secondly, I'll say that we do not intend to proceed with issuance of a CBDC without clear support from both the executive branch and from Congress, ideally in the form of a specific authorizing law. So we did get, it was very gratifying, 2,000 and some comments, and I won't tell you that I've read those, but I've read all of them. I've read some of them, and I've read the summaries, and it's a lot of very thoughtful concerns, including the ones that you raised, and they're things that we're considering very seriously. So we in our own paper we suggested that a CBDC in our jurisdiction should be privacy protected, intermediated, widely transferable, and identity verified. So on privacy protection, let's start with that. Very, very important. And we all see what's happening with digital RMB and the issues with privacy. We would not want a world in which the government sees in real time every money transfer that any with a CBDC. That would not be something that would be at all attractive in the American context. So privacy protection is going to be extremely important, and we're attentive to striking a balance, of course, between law enforcement and privacy protection. But that can be managed in the same way that it's currently managed in the bank, some similar way. In terms of another issue, really is disintermediation, and that really is a question of, if say you had an interest-bearing CBDC, it could be attractive. It could compete with deposits, could draw deposits out of the banking system. That could limit credit availability. that's another issue to be managed. I think one of the things that actually that Cato mentioned in your was also the run rent issue, and that is the question of, are you creating an asset that would be very attractive in a panic or severe stress situation, and fostering runs. So look, it's going to be, as I mentioned, it's going to be, we think our role is this. We want to carefully and thoroughly analyze the public policy and technological challenges, public policy trade-offs and technological challenges. That's what we're doing. The idea is that this will lead all of us to a better understanding of those trade-offs and prepare the way for well-informed decision.
I've been typing into the chat area of Zoom in case anyone didn't know that.
Our role is.
There's been lots of
we think that the Fed is the right institution to do
triggers,
that. We
trigger
can
alerts.
Proceed without, we're a nonpartisan institution, non-political institution that we can do these things, and I hope present conclusions and analysis that will support an intelligent decision when it's time to make that.
Something we'll definitely be having a lot to say on it as well, really from a perspective of block on those issues. I want to ask about cryptocurrency. First, I should probably, in fairness, reveal the gentleman who photobombed behind her during her Humphrey earlier this year became my son. So, that's a little bit of a disclaimer I'm going to put out there. But without debating the merits or products,
PIXY is open at 27.50.
Cato stands for nothing if not a.
Make sure you take profits underneath every dollar level on stocks above $20.
Concern about our discretionary field, and also we and experimentation. We find really disappointing. If you could respond to these, crypto.
So I'll talk about it in two pieces. One is unbacked cryptocurrencies as such, and those have not and don't appear to offer, have not offered and don't appear to offer much in the way of public interest in using them as payments. Let's say it's it's not a great store of value. What it is a speculative asset. It's not backed by anything.
There could be an argument that that's still during the development.
Yes.
Yes, it may.
And I also have close in family members who offer that perspective vigorously. So, as you suggest. But stablecoins is a different thing, and the question is, are there forms of private money like stablecoins which can play a role in our financial system, which would, and the answer is, of course, that we don't want to stand in the way of appropriate innovation, particularly including digital innovation. But we think that something like that, which is purporting to be money, would need to be appropriately regulated. And I hear that wide agreement on that, by the way, from a lot of the stablecoin companies now are seeing that as part of getting to a place where they are a legitimate part of the financial system. So I think you need regulation. If people are going to think something is money, then it needs to actually have the qualities of money. And if it doesn't, then you don't want. I don't think you want to take money and make it into just another consumer product where sometimes it fails and sometimes it's good. You want it to be guaranteed to be good. If the public's going to look at it like it was $1, you want to have clarity, transparency. You want to have full reserves of very liquid, high-quality assets, and things like that. That's all. So I think that we need legislation on this. Just it's typical of technological innovations. There isn't a regulatory framework that really gets after payment stable coins. And so I think that's what's needed. But I wouldn't think of us as
sharp move up on the market.
We're more the people who are saying, among others, that we need appropriate regulation.
Yeah, the devil's ultimately in the details.
IMRA.
Where we will see, we basically promote.
I see.
Focused.
And I agree with that. We don't want to be in that place. We want to be in favor of innovation, but also appropriate regulation.
Other topic I can remember as successive chairman of Warren DeVarnes. Regrettably, no one in Congress or the White House seems to be listening.
Holy cow on MRA, IMRA. Nice move up. Hopefully you got pre-entry above 2.1. Coop, day 2 follow through.
Has ended. Lessons of the financial crisis.
That'd be a swing trade.
Fiscal housing order essential as preparation to meet the opposite lesson seems to have been reckoning. And I just, I'm very
$1 of risk.
I do share those concerns, and in fact, I was working on those issues before I joined the Fed. But at the Fed, my position needs to be that fiscal policy really is the responsibility of Congress and the administration. Wouldn't be appropriate for me to comment too much on specific policy proposals or laws. More to the point, with inflation running so far above 2%, this is probably an especially good time to focus on achieving our own mandate.
Yeah, we're watching RVNC.
Doling out advice to others. But like my predecessors, I'll point out that our federal fiscal policy is not on a sustainable path, and it really hasn't been for some time.
I flipped long on the market a couple minutes ago.
Sooner or later. To your point, sooner is better than later. And I guess I'll just leave it at that.
The end of our question. With everything that we've discussed thus far, advice might you give to Cato and other places?
So I guess I would say that both experience and also studying history
young future Fed chairmans.
What can be hard lessons. And I actually mentioned 3 lessons.
Hey, little Johnny, you're going to grow up to be an excellent Fed chairman.
10 days ago, and those were first that the Fed does have and accept responsibility for price stability. Even now, some are questioning that, but that to us is settled. Secondly, that inflation expectations are really important and need to be careful monitor, because if they do move up, they can make the job of getting back to price stability so much harder. And third is that the record is there is a record of failed attempts to get inflation under control, which only raises the ultimate cost to society of getting under control. Hence the need to do this job now and keep at it. So those are 3 lessons. I would say more broadly, another really fundamental lesson to me is that the structure of the economy is ever changing and highly complex. And we see that today around the world. Many nations are experiencing the first high inflation in 40 years all around the world. Different countries have different composition and backstories, but it's really quite global. And
yeah, the PIXY trade is over.
Is this going to be a temporary thing that's really related to pandemic in some way, or is there actually something more structural and persistent happening? For example, if we're moving
first
to a
halt
world
down, now it's the second halt down.
We're going to see more frequent, larger, and more persistent supply chains.
Coop up $1 since entry.
That will have critical and difficult implications for the conduct of economic policy and monetary policy in particular. So this is not possible to know right now, but it's certainly a question that looms. I mean, to me, to sum it up, I would just say economics is not physics. There isn't any specific temperature at which the economy boils over. It does boil over from time to time, and when that happens, it often takes many years of analysis, discussion, and debate to reach general agreement on why that has happened. So the point is that we are always making monetary policy high uncertainty about the structure of the economy and the path ahead. That makes our work challenging. It also makes it getting it right very important for the people that we serve, and we do think about that every day. So our understanding of the economy has to evolve. As the economy evolves, as time passes, we do learn more, and I think it's okay to follow the evidence and change one's mind. I think advice to scholars young and old is that people shouldn't be afraid to say that they've changed their view and explain why. I actually find that refreshing when people say, my view has evolved in the face of the evidence. I guess one more word to close for young researchers you mentioned, and this is a commercial for public service and for the Fed. So the Fed is a very special place where people can combine policy research with policy making. This is a place that has, and all of us have a very strong sense of mission in our work, which is very satisfying. And that mission is to serve the public. And it really matters. Our work really matters to the public. I would say there's no higher calling or more satisfying mission. So I hope that young researchers and economists and others will consider public service as part of their
This guy's like the Pharaoh of Egypt.
But in particular, consider working at the Fed.
Thanks for that. I mean, I share at Cato because within that context that they occur.
Thanks, Peter. The pleasure is mine, too.
So much. And that, I'm just going to let all
My pleasure. You too.
All right, you guys, that's it. It's it has happened, and the market is now moving up because volatility is being released. Essentially, it may not be the actual move. It may just be because volatility and uncertainty has been removed from the market. And so therefore, options sellers are now interested in selling calls or buying, even flipping over to buying. So this up move in the market may just simply be volatility release. Then that's all it is potentially. So watch out. It could break down again at any moment. You never know. But if it's going to follow yesterday's lead, perhaps it'll be another grind up day or up day. And if so, the real confirmation of that would be for price to break yesterday's high. Be watching anything and everything that breaks yesterday's high. That's all part of the orchestra.
Alert.
Every player in the orchestra playing its part. And so if you see anything making new highs over yesterday's high, that's a serious market cap, $2 billion or more, or any indexes, that's a good sign. COUP, C-O-U-P, is now at 67.80, so that's $2, I believe, above, or 60, something like $2 above entry. Which was alerted. One resistance point to watch out for is on the market is yesterday's closing price. So that's right here. On SPY, on the Dow, on the Qs, it's going to be a different level to those. Chart over here. Any questions, anybody? There goes Ruby, another 7% over $1 now. Porsche IPO is on. Yeah, but what's the ticker? So we'll just keep it up for when it happens. IC at almost 17 now, 1670. ISEE. Let's take a look at the daily on that. Yeah, it's up and away. Somewhat recent blue sky. Cloudy with patches of blue. That started at about $16. Sky. SPY just broke confirmation, first confirmation level of yesterday's close. SPY, no, not SPY. The Qs. The Qs just did. So the Qs growth are leading the way. Growth stocks are saying, this sounds good. And so this dip essentially is being bought up. This 3-week dip is essentially starting to get bought up. And yesterday's trigger on across the market of going up above the prior day's high was a signal for a swing entry that the market may be likely has reversed and is going to either pull back for a couple days upward in a downtrend, or it's going to rally for a couple of days or more as a leg in an uptrend. Either way, it's going up. Looks like we have entry on PRVA, a high growth stock swing trade. PRVA for $3 of risk. That alert's going out now. Let's take a look at Enphase, ENPH. Enphase is up even more. than yesterday. Hit 324 today from our entry of 300. So that is now up almost 8% since yesterday's entry. Absolutely phenomenal for swing trade, for high growth swing trading. A 2-day 8% gain, very strong. I still wouldn't even take first profits until 10% though. Mulan is taking off. Mulan, or whatever it is, Mullen is taking off after a halt. No, it looks like it's down now. Doesn't seem to be fully the case. And while the Qs have gone up and over yesterday's close, the Dow and the S&P 500 still have not. So there's still progress to be made here. Very cool. Yes, the ABCD, but just realize that it takes a while to really understand when those are there. You can tend to read an ABCD into almost anything in the beginning when you have Dunning-Kruger. So watch out. And it's more important how perfect they are than trying to find something that's scraggly ABCD. You guys, Ruby, looking fantastic. Now about to break pre-market high of $1.15. That'd be 15% up over entry at $1. Ruby. And IC continues to make minor progress. It's at 1672, around 16.8. Looks like it's going to try and test 17. Yes, I'm live every morning. If you're interested in checking out our trading group, you can go to e3tradinggroup.com. That what was I going to say is also a link in my bio. So if you need to go over, click on something, that's the easiest way to do it. Once you do go over to the website, e3tradinggroup.com, check out my potential play on VIOT, value stock, with over 200% potential upside, nearly 300% potential upside. It already has. Somebody just asked, if SPY breaks yesterday's high, do you think it will turn around? It already did that yesterday. It broke the previous day's high. So it did turn around. And you're a day late. And $1 short. There goes Ruby, just broke out, $1.15. There it is, Ruby. Who's killing it on Ruby? All right, Mike W. That is the 20 and the 200, yes. But I also like to watch the 8, the 10, the 50, and the 100. That's what you're asking about. You can go to my website and click on Learn to Trade. It's in the upper left. And that'll take you over to Market Mastery. And you can learn all about how to use moving averages to measure the momentum of your trades. They should call momentum averages. Ruby's doing great, way above WAP, continuing to just charge higher. Mike's in at 97 cents. Do I use leverage when I trade? Not per trade, but on my account, yes. In other words, I might get into 8 positions, and 4 of them are on margin, but all of them together are at 1/8 risk to my account, well below leverage. So other than, nuclear catastrophic loss, love the lava lamp. Yeah, my kid didn't need it in their room anymore, so I'm like, give me that. That's going to be perfect. How do you determine whether to use leverage or not? Fuzzy Duck, if you just go to my website, e3tradinggroup.com, and then click on Learn to Trade, you'll come over to the Market Mastery, and in there is an entire lesson on the 1% rule. And the 1% rule tells you how big to make every trade. Fuzzy Duck needed to know. The market with a swift pullback just now. That's what I was talking about. Watch out. I think Dillard's will rise significantly soon or fall. I don't think it's going to rise significantly soon, no. Alerts are sent all day by multiple analysts, such as myself, that are that lead our group. My group, you just go to the link in my bio, and it's free to check out. Check it out for free. All right, first pullback on Ruby in a while. I'd be watching the 2-minute chart for a re-entry or a cheat entry. Which would be on the 2-minute chart, green over red. VIX is at 25. So still elevated. Yeah, you're getting suckered into biotech pump and dump. I'm not seeing anything good about RVNC other than, what it's got going on in the pipeline. And we don't really specialize in biotech here and FDA pipelines, but if you do, then that's great. At least you know what you're doing with that. But hopefully you do. Hopefully you know what you're doing. A Botox drug. Yeah, geez. I remember about 10 years ago, a particular Botox company had Botox news and boop, pump and dump. About a lot faster than a Botox treatment. It was up and down in like 2 days, as usual. Ruby is still be watching those 2-minute charts, looking for a break of prior high on the 2-minute for reentry or add-on. Asana on that gap fill has reversed on the push up that was on the market. Should be over with on that gap fill. All right, the market's making its way back up towards the high of the day. Certainly was higher in pre-market, but high of market. And it'll be interesting to see if it rejects or goes further. And for that, let's watch slowly and stay connected in the group. Let's go move into the group, guys. Have a good morning, and let's talk over there. Thank you for tuning in. Yep, you bet. Hopefully you got some of that. You know, wasn't alerted out of my voice, but boy, we were all over PIXY, which should have worked out. You know, not to be in a halt down. So you didn't get trapped in that. By the second halt down, you know, should be way all out. And PIXY and Ruby and IMRA were the hot stocks, and Coop looks like it's ready to break the high of the day for continuation. All right, see you in the group, guys.